If you're making $300,000 to $500,000 a year, you're probably paying 35 to 50% taxes to the IRS. Did you know that there are plenty of people in your same income bracket? I'm talking about doctors, lawyers, and executives who are making $300,000 to $500,000 a year and they're not paying any taxes. I mean, literally zero taxes. And I'm not talking about people who are hiding their money in an offshore account somewhere or using some complicated tax avoidance strategy. I'm talking about legal strategies that the IRS allows you to use to eliminate your taxes, or if you don't want to get too fancy, you can at least reduce your taxes. My name is Kate Lynch, and a couple years ago I decided that I wanted to get out of my corporate job so I could spend more time with my kids. When I did, I was shocked to learn that the tax savings available from real estate investments can literally eliminate your tax burden entirely. One year, in fact, my accountant reached out to me to ask if I really wanted to take all those deductions because we reported almost zero income that year, and he couldn't believe that with the amount of money we brought in, we could have zero income on our bottom line. When I look back at the last 20 years, when I was earning $300,000 to $500,000 a year in a commission-based job, I'm so angry that I did not take the time to learn about how to use real estate strategies to reduce my taxes. I paid millions of dollars in taxes that I didn't have to, and if I had known then what I know now, I realized I could have set myself up so that work would be entirely optional by the time I was 40. Today, my goal is to teach you what I've learned since I started investing in real estate so that you can take those steps now to both reduce your taxes and set yourself up for financial freedom so that work is optional for you when you're ready to step away. So the key to this strategy relies on the opportunity to take non-cash deductions from real estate investments that are considered active investments. Specifically, this strategy focuses on buying a vacation home that you then rent as a short-term rental. You need to make sure that you're buying a property that will generate a lot of tax deductions. I made a whole other video about the type of properties that are likely to create that kind of deduction. In our case, I really uncovered this strategy in a situation where we bought a $650,000 vacation home that created $250,000 worth of non-cash deductions on our taxes. Once I did the math, I realized that the savings we had on our taxes that year were actually more than the amount of our down payment on the house. So effectively, the IRS loaned us the money to make the down payment on that house. I could have either paid the IRS the taxes or made a down payment on the house. And the cool thing is, there's no interest on this free loan from the IRS, and you don't have to pay it back until you sell the house. Even better, once we own the house, for us, that property generated $40,000 per year of income. Can you imagine redirecting your money from a tax bill to a down payment on a house so that you start generating positive cash flow from an investment? You also get to use that house for personal use for up to 2 weeks of the year. It's an incredible way to start building a real estate portfolio at effectively no dollars out of pocket if you're in a very high tax bracket because you have a high-paying job and you're willing to manage the house yourself after you buy it. Now, you might be thinking that you're way too busy to manage a vacation home as an Airbnb. If that's the case, I have 2 comments. First of all, managing an Airbnb takes way less time than most people realize. I'm currently managing 17 Airbnbs, and I do that in about 4 to 5 hours a week. So if you're only acquiring one vacation rental, you absolutely can manage that once you've got the thing set up and running in around an hour a week, maybe less. Sure, there might be some weeks when you spend 2 hours on it, or maybe even 3, but if you're earning $300,000 to $500,000 a year, the ability for you to get an extra $100,000 is definitely worth spending 2 or 3 hours per week, in my opinion. And recognize that that $100,000 that you generate is effectively non-taxable income because you're directly reducing your taxes by that amount. You could utilize this strategy to completely eliminate your taxes. What you would have to do is figure out about how much you pay in taxes each year, and then what dollar amount of real estate would correlate to reducing your taxes by that much. You could do it by buying a couple of homes that together generate enough deductions to offset your income, or you could do it by buying one large home. For example, in my case, I was able to get $100,000 of tax savings from a $650,000 home. You then could just apply that at a higher level where you're buying a $1.3 million house to get $200,000 worth of tax savings. For some people, it might feel too risky to go that big their first time around. So instead, you could start with just a single home. I'm going to say one vacation home in this $600,000 to $800,000 purchase price can generate around $100,000 of tax savings. After you buy that first home, you manage it for a year or two yourself to get comfortable with what it's like to manage an Airbnb property and get a sense for how much income you'll get from the new property. The cool thing is, if you decide that managing an Airbnb is not for you, you can then just shift that house to a property manager. You do not lose the tax deductions that you took historically. You just no longer can take the same tax deductions going forward on your existing property. So the $100,000 of savings that you got when you bought that house, that's locked in. In theory, you could buy one house each year and just manage that house actively for a year and shift them all to passive management over time so that ultimately you own 5 or even 10 houses that are managed by somebody else. As long as you actively manage them in the year that you were taking the deductions, you're fine shifting them in future years toward passive management. If you just buy that one house your first year and then do the same thing again your next year and buy a second house and a third, a fourth, and a fifth, at the end of 5 years, if you're buying houses in this price range, you're going to have about $3 million worth of real estate. That's 5 vacation homes that you and your family can use to take incredible vacations. You could have one beach house, one ski house, maybe one by a place that you like to go hiking. Really let your own dreams determine what kind of properties you want to be investing in. In order to make the strategy work, you absolutely want to be investing in properties that have positive cash flow. In our case, we were able to get around $40,000 per year of profit from the house that cost us $650,000. But the reality is, as long as it has positive cash flow, you're already getting your $100,000 of tax savings up front, so it doesn't really matter how much the house makes in profit after you acquire it, as long as it's paying its mortgage and paying for its taxes and not having a negative cash flow. If you eventually plan to shift this to a passive management strategy, you'll also want to make sure that the house is generating enough income to pay for a property manager to take care of the house when you no longer want to actively manage it. In this interest rate environment, if you're buying the house well, you should be able to get at least $20,000 to $30,000 per year of positive cash flow from a house that's actively managed. 5 houses, each making $20,000 to $30,000 a year, means that 5 years out, you're bringing in $100,000 to $150,000 per year of new income that you didn't have before. That's coming from a $3 million real estate portfolio. If that portfolio is generating a profit, that means that your mortgage payments every month are reducing the principal that you owe on the house. On a 30-year mortgage, the long-term average is about 3% per year being paid down on your principal. Obviously, it's less in the early years and more in the later years. But over time, you're averaging about 3% per year. So 3% per year principal pay down on a $3 million portfolio means you're adding about $100,000 on average each year to your wealth because of the just reduction in principal from the house paying its own mortgage. If the real estate value is also appreciating at 3 to 4% per year, which is pretty modest for most vacation rental areas, you're generating another $100,000 or more per year of wealth for yourself. That's non-taxable wealth creation. So you're getting, let's say hypothetically, $100,000 to $150,000 at least of new income from the property, plus about $100,000 per year of non-taxable income from principal paydown, and about $100,000 per year of non-taxable wealth from your appreciation on the property. That means in 5 years, you've effectively replaced your income from just buying one house per year, completely funded by the IRS. This tax savings, I think, is the most phenomenal way for you to set yourself up for long-term success in life. If you just buy those 5 houses and you decide to stop there, you can go back to paying your regular taxes if you feel happy with it. Most people get a little bit addicted to this tax savings and continue to roll their profits into newer and bigger houses because they don't want to go back to paying taxes. But it's okay if you feel like that's enough for you. You can stop there and own those 5 houses, and you will have set yourself up to make work optional for yourself whenever you're ready. If you're interested in learning more about how you can use this kind of strategy to create financial freedom for yourself, please hit the like button and hit the subscribe button as well to show us that you like this kind of content and help our channel grow. I'd love to invite you to follow along on our journey as we use real estate and tax saving strategies to create financial freedom for ourselves and for the other people in our community. Thanks for watching the video. If you enjoyed this one, check out some of our others to see if you can find some others that you'll enjoy.